Okay, good day everyone. This is the second episode of Bite Size News. Right, this is on US jobs report, treasury yields, and how it affects SG REITs and banks. Right, dated 14 January 2025. Right, please note I'm not a financial advisor and this is not financial advice. I may make mistakes and do not guarantee information shared is all accurate. Right, everything I say is for educational purposes only. Right, last Friday the US announced a job report which added 256,000 jobs in December, right? And unemployment rate ticked down to 4.1%, right? This is much better than what they expected, right? So the analysts expected 155,000 jobs to be added, with unemployment rate staying at 4.2%. So basically their jobs market in the US is very strong, right? So this probably reflects to us that the US economy is still quite healthy. Right, so we look at what the Federal Reserve's mandate is and what the implications are. So the Federal Reserve has two jobs. One is to maintain as high as employment as they can. Number two is to maintain stable prices, right, with inflation at a low number over time, right? So they're trying to hit 2% inflation, right? That's the reason why they raised interest rates so much in the last 2 years, right? Now they're trying to drop interest rate back. Right. Why are they dropping interest rate back is because they are worried that if they keep interest rates too high for too long, it will cause this part to suffer. Employment, right? So if businesses cannot manage the debt expense and they go bankrupt, then employment will drop. And employment is one of the things they have to take care of, right? But now it looks like employment is okay, which means to say they don't have to worry about lowering interest rates as fast anymore, which means that this is bad for REITs, right? Because if initially they were suggesting they may drop interest rates twice this year, it may now reduce to dropping interest rate one time this year, right? So that means to say REITs will stay in a higher interest rate environment for longer, right? So this is not a positive thing for REITs in general, right? We also want to look at the 10-year treasury yield for the US market, right? So why we want to look at this is because I think this has some effect on our dividend bearing stocks in Singapore as well, right? So this 10-year government yield bond, right, is actually going up, right? So initially this part, right, people suggest that it's actually pricing in a Donald Trump victory lah. So people were concerned that Donald Trump is going to win, and Donald Trump's idea is to impose tariffs on Canada, Mexico, and Singapore, and not Singapore, sorry, China, right? So 10% for Mexico and Canada, and 60% for China, right? That's going to cause massive inflation, right? So when inflation comes, right, people are not willing to buy government bonds at low interest rates. So let's say at that point of time, maybe the 10-year bond yield around 3.8%. But if they expect inflation to be 4.2%, right, then it's not logical to buy the 10-year bond anymore, because your 10-year bond will return you 3.8% after 10 years, but then inflation go up by 4.2%. So that means overall your buying power still drop, right? So people will wait for the yield, right, to go higher. How does the yield go higher, right? The bond price must drop, all right? So because the annual coupon for the 10-year note that is being traded in the market is fixed, right? So that means this numerator is fixed. So for the yield to go up, the bond price must drop. Alright, so what happens is that people don't buy the bond until the yield goes up. But how does the yield go up? The bond price must drop. So they wait for the bond price to drop enough so that the yield is high enough for them to buy the bond. Right, so that's how this thing goes up. Right, so this thing goes up because the bond price is going down. Right, so people are not willing to buy it at a high price. Right, so this front part is probably due to people anticipating Trump's victory, alright, although I don't think it was that clear when it was pre-election. Only post-election, maybe it seems to be more true, alright. Okay, no one actually, I think, really knows why, but we can think about the possibilities, right? So, but what's with the current carry-on of this hike in yield of the 10-year government bond, right? So I think there are three possible reasons. Right, so one way to think about it is that treasury bonds are actually safe instruments, right? And if people are worried about recession, then they will buy bonds, right? So because 10-year treasury bonds is backed by the US government, right? So after 10 years, you confirm get your money back, right? right? So if you're worried about recession, then you will buy these 10-year treasury bonds, right? So if demand for 10-year treasury bonds are high, right, the price will rise, right? So if we look at the same formula, if demand is high, the price will rise, the annual coupon payment is the same, so this number as a fraction will drop, so your yield will drop, right? However, this is not what we are observing, so people are not worried about recession, right? So we actually observing the yield going up, right? So bond price must go down, right, which is what we discussed earlier. This means that it suggests that there's low demand for bond prices, which means that people are not worried about recession, right? So this is one possibility, one possible hypothesis that we can have from looking at this chart, right? People are not worried about recession, and it seems to gel with the job reports, right? Worries about inflation, we talked about this before, right? Because if inflation is very high, then I need to demand a higher bond yield before I bother buying a bond. Otherwise, my buying power will just deteriorate, right? And finally, the third one, which I don't think is the case, but I think I just have to put here because it is a possibility. The government debt of US is getting very high, right? So it is possible that people are starting to worry about the fact that government cannot pay back its debt, right? However, this is obviously running in contrast with number one, right? So if they're worried about government debt, right, that means they think the government debt is becoming more risky, then they will demand a higher yield to compensate for it again, right? So if you look at countries or at risk of defaults, right, their government debt yield can run up to 15-20% of interest, right? So these are three possibilities, all right? Then we want to see how this affects SG REITs and banks, right? So remember that traditionally the US 10-year treasury bill is considered the most safe asset, right? Because it's backed by US government. Is the US government likely to be around 10 years later to pay you back your money? Very highly likely lah. Nothing is 100% in life, but I would say that probably above 95 or 99%, right? Yeah, but if you compare it with our Singapore REITs and banks, right, they're offering dividends as well. And you can have a look at these values over here, which was from yesterday's presentation on retirements block, right? So this is the yield of Ascendus, Escort, CapitaLand China, CapitaLand India, and CICT, right? If I were to compare these five REITs, which do I think is the safest REIT? I think CICT. And if you look at the yield, right, CICT has the lowest yield, right? Why? Because it's considered to be very safe, right, as opposed to its partners, right? At least in my opinion, right? Then if you compare this with supposedly the risk-free rate, right? So this is like more or less 99% or 99.9% risk-free, right? US is likely going to be around 10 years to pay off the debt that they owe you, right? Then you can see that this offers less than 1% more than this, which is supposedly zero risk or near zero risk, right? So what this means is that this yield from the REIT, right, is starting to look unappealing. And for this to be more appealing, right, the dividend have to go up, which means the price has to go down, right? So hopefully you understand why when this thing goes up, right, it can exert pressure on the price of the REIT, right? And maybe that's why the REITs have all been compressed as well, right? This is one possible reason. Okay, again, many possible reasons, but I think this is one of the issues that are causing distress to REIT prices at this point, all right? And I think that it's possible that it's also causing some distress, or rather exerting some downward pressure to the banks as well. So if you look at the recent bank prices, right, at least the last 2 days, today and yesterday, it looks like the prices are coming down, right? So again, banks are seen as in Singapore as dividend plays, right? So again, if you compare the risk-free rate, DBS yield is not much higher than this, right? So I would say DBS is very safe, but most people would consider the US safer than DBS. So that's why when this thing approaches the yield of DBS, it's possible that DBS price may fall to offer a higher yield, all right? Yeah, with that, I would like to say that none of this is, I think, is guaranteed true, all right? It's just hypotheses based on what I understand about the market, all right? None of them is meant to be financial advice, and thank you for listening.